Good morning. I hope today finds you well and peaceful. Today I'm going to cover the second half of Chapter 9. It's actually sort of 4 separate topics, so you can chunk this lecture if you want, and I'll try to provide some guidance on that later. Well, let's kind of pick up from Part 1, this idea of cost allocation depreciation. And we had actually said that's really taking the cost of these long-term assets and spreading it or allocating it over the useful life of the asset. But today, I want to look a little closer at that. So let's look at this whole idea of cost allocation. So again, we acquire these long-term assets. We're going to depreciate by allocating the costs while we use them, and that will expense it during that period of time. And so what we saw in my first lecture, we just looked at straight line depreciation. Well, the reason, just a minute. Let me start those dots all over again. But the reason it's called straight line depreciation, we had calculated, if you recall, $1,000 each year for depreciating the asset. And so that would accumulate $4,000, right? And again, that's the straight line method, and the reason it gets its name is essentially it's just a straight line across time. But there are also other options out there. And one of the theories is that we actually get more benefit out of these long-term assets early on in its life. So we should be depreciating more cost early on in the asset's life and then not so much later on in the asset's life. And these are called accelerated methods. So we're not going to do the calculations for accelerated. There are different accelerated methods, and we're not actually going to get into the calculation for them. At this 200 course level, we're really just going to look at the theory. So keep in mind, we accumulated $4,000, right, of depreciation using the straight line method over 4 years. If I accelerate it, I might have $2,600 the first year. And the second year, I might come in here somewhere around $1,300. By the way, these are actual numbers if I used a method called double declining balance. And then the third year, clear down here like $100, and then that would be it. And again, that's an accelerated method. And again, I'm adding up or accumulating 4,000. If I had 2,600, 1,300, and 100, it'll add up to 4,000. And we can kind of see, it's got a very downward slope to it. That's an accelerated method. So here's kind of the interesting thing about these accelerated methods. Let's kind of review back when we studied costing inventory and allocating that cost between ending inventory and cost of goods sold. We saw we could use FIFO, LIFO, and weighted average. So we did that on the financial statements, the income statement, the balance sheet. For tax reporting to the IRS, I also have the same choices. I can choose FIFO, LIFO, or weighted average. Okay, so we really didn't talk too much about financial statement reporting and tax reporting, except we can use different methods, right? I can use FIFO for the financial statements and maybe LIFO over here. Okay, and so for property, plant, and equipment, these long-term assets, I can use straight line or an accelerated method. And I've got DDB here for double declining balance, but there are other options as well. I really want to compare straight line and accelerated. For tax reporting, I can use only one choice of accelerated method, and that's this thing called MACRS, Modified Accelerated Cost Recovery System. So the Congress created this depreciation method called MACRS, and it's very, very accelerated. Matter of fact, where the county rules would allow this, MACRS, it could almost, maybe just 2 years. I mean, it's just very, very fast. So I have choices for tax reporting. The only accelerated method we can use is MACRS. but I can also use a straight line method. Over here for financial statements, I do have double declining balance here, but the counting rules does not allow makers. That's really the point I want to making. So while I might be able to use this double declining balance, for the income statement, I'm not allowed to use makers. So that kind of makes things a little complicated. And we're really not going to get too heavily into that. I just want to point that out, that makers is so accelerated. It's such a steep slope that the Financial Accounting Standards Board said, we're not going to allow you to use that. Okay, but let's go back to the big picture. So, don't get frightened away by all these numbers. I'm going to kind of go through them, and I think as we walk through them, the numbers are going to give you a little bit of an aha moment. So, let's say we have 4 years here, and I just made up income. If I exclude depreciation expense and income tax expense, let's just say it's $3,000 a year, that it stayed the same, which is very unrealistic, but it keeps everything simple. With the straight line method, remember we said $1,000 of depreciation expense a year, and of course that will accumulate to $4,000. So then that gives us income before taxes of $2,000. And then assuming a 30% tax rate, which no longer exists that high, but back in the day when we did have 30%, income tax expense would be $600, and the core income before taxes minus income tax expense gives us our net income. And that's what this would look like. So a company might choose to use straight line for their income statement, and it would look like this. Now, at the same time, they can use an accelerated method for their tax return. So let's assume they use an accelerated method, and I put that 2,600, 1,300, and 100 in here just to demonstrate even if it's not makers, but the same theory will apply. If I had an accelerated method like this, what would things look like? So again, income before depreciation, subtract out depreciation expense, and I get my income before taxes. Take that times 30%, and I get my income taxes. Except this isn't our expense because this is on our tax return that we report to the IRS. That's going to be the cash payment that we actually have to make to the IRS. And then I just netted that, right? Income before taxes less what we pay. And I called it net income. It wouldn't probably have anything here. But I wanted this for comparison purposes. So we go all the way through this. So what's kind of interesting is because we have different depreciation expenses, we have different income before taxes and different income tax amounts. So I'm going to have, like in year 1, this expense of $600 on the income statement, but we're only going to pay $120. So that actually kind of gives us, in the short run, this $480 cash savings, right? Our actual income tax cost is $600, but we're only going to pay $120. We save $480. And now you can kind of get the sense of, well, why would a company, go through all this process to have, this depreciation schedule for the income statement and this depreciation schedule for the tax return? And by the way, it's fine. I'm not having two sets of whole accounting systems. This isn't the whole accounting system. All this is the depreciation record. And so I'm going with one method for the financial statements and another record for the tax return. The point is, in the long run, it's all going to even out. Anyhow, it just gives me some short-term differences. Let's go to the second year. So we expense $600 on our income statement, and we pay $510. And again, we see some savings of $90. And if I accumulate this, so let's do the cumulative savings. So we started with $480, we're adding another $90, now we're at a total savings of $570. Very nice. And if you make this $570 million, which it would be, or billion for some of these really large companies, you can see why they're going to hire extra accountants just to do these calculations. Okay, now the third year gets interesting. The third year is when the depreciation methods flip-flop. So I'm going to expect then it to flip-flop over on my cash savings. So let's look at that. So this time, pull the screen down a little bit. I have income tax expense again of $600, right? This number. But, whoa, we pay $870. And again, notice this is when we're flip-flopping. Depreciation was stated $1,000, but now it's gone below $1,000 on the tax return. So things turn around, and I actually start paying back some of that savings, right? I have a negative $270, and so now my cumulative savings are $300. And then the last year, it totally flip-flops, right? $600 is expense. I'm going to pay the IRS $900. There's my $300, and I'm zeroing out. So in the long run, our total profit stays the same in both reporting cases. Depreciation's the same. Income before taxes. Tax expense equals the cash paid. This is why, sometimes, it gets said in the media that, some corporations, they have, and maybe they do have unfair tax laws. I'm not a corporate tax accountant, but I do know sometimes it's just timing differences. So early on, a company's able to defer, right? They defer paying this $480, the $570, but then it turns around later on and they end up paying it again. So it's not that they never pay their taxes, it's just deferring the tax payment. And that's what we see here with the depreciation. So I can speak to depreciation, expense, and tax law.